So when we're considering the money market, we have M, or the quantity of money, on the horizontal axis. And remember, money is currency and also checkable deposits. So just like when we talked about money last week, money is not only cash, but also money that we have in very liquid accounts. So we're looking at the quantity of money, and on the vertical axis, we need something that's akin to the price of money. And that's going to be R, our nominal short-term interest rate. And remember that the nominal short-term interest rates are going to be the cost of borrowing money on a short-term basis, or the return to saving that money. So really, it's the opportunity cost of holding money. And when the opportunity cost of holding money, instead of putting it into something that's going to earn interest, when that opportunity cost falls, or when that interest rate falls, people want to hold more money. So the quantity of money demanded is going to increase. So our money demand curve, which I've abbreviated MD, is going to be downward sloping. And whenever we have a change in the interest rate, then we're going to have a movement along that money demand curve, or a change in the quantity of money demanded. So a change in the interest rate is a movement along the money demand curve. So now we want to think about the factors that might shift the money demand curve. So regardless of what the interest rate is, change the amount of money that people want to hold. So that brings us to the factors that shift the money demand curve. The first one is a change in the aggregate price level. If the price level increases, then money demand is going to increase because we need more cash to buy the goods and services that we want to purchase. Another factor that shifts the money demand curve is changes in output, or real GDP. When output increases, so increase real GDP, the money demand is going to increase because we're going to need more money to buy the goods and services. And now there are more goods and services to purchase, so we're going to need more money. Another factor that will increase, or will change the money supply, are changes in credit markets and banking technology. So, for instance, over time, the popularity of credit cards has increased, and as people have been using cash less, using debit cards and checks less, the demand for money has decreased as we've moved to using more credit cards. And finally, changes in institutions will affect the money demand curve. So for instance, historically, interest was not allowed to be paid on checking accounts. So it was allowed to be paid in savings accounts, but not in checking accounts. But when banks started being able to pay a small amount of interest on checking accounts, then people wanted to hold more money in checkable deposits, which increases the money demand. So one thing to remember is that whenever we're talking about money demand, money supply, we're talking about cash, currency, and checkable deposits. So anything that makes us want to hold more money in our checking accounts or more money in cash is an increase in the money demand. So now let's discuss the money supply. The money supply is controlled by the Fed. That means that the money supply is going to be perfectly vertical. So So there is a certain quantity of money available at any given time, regardless of what those nominal short-term interest rates are. And the way that the Federal Reserve controls the money supply is by buying and selling government securities or bonds. So if the Federal Reserve wants to increase the money supply, then the Fed is going to buy bonds. So in exchange for these bonds, the Fed will give banks money in the form of increased reserves. So all of a sudden, the banks don't have any additional deposits, but they have more money in reserves, which means that they have more money that they can loan out. And when banks are making more loans, that is going to increase checkable deposits, which increases the money supply. Which is a shift to the right of that money supply curve. Now, if instead the Federal Reserve wanted to decrease the money supply, in this case, the Fed is going to sell bonds, which means that it's going to give bonds back to the banks and in return take money out of the bank's reserves. And as the bank's reserves fall, they're going to have to decrease the loans they're making, call in existing loans. Those loans will be paid back with checkable deposits. So we're going to have a decrease in loans and a decrease in checkable deposits, which is a decrease in the money supply. And we can represent a decrease in the money supply as a shift to the left of that money supply curve. So now if we want to find equilibrium in this money market, we can look at our money supply curve and the money demand curve. And when the quantity of money supplied is equal to the quantity of money demanded, then that is what is going to determine that equilibrium short-term interest rate. So if there is a change in money demand, so let's look at an increase in money demand. A change in money demand, if we have that increase in money demand, that is only going to change short-term interest rates. So it's going to change the interest rate, but not the quantity of money, because money supply hasn't changed. A change in the money supply curve, now let's look at an increase in the money supply. An increase in money supply is going to lead to both a change in nominal interest rates and also the quantity of money. So the only thing that can change the quantity of money is a change in the money supply. But either a change in money supply or a change in money demand will affect those equilibrium interest rates. Everything else remaining unchanged, in which direction will the equilibrium interest rate if the central bank of the country buys government securities in the open market? Pause the video and see if you can figure out what will happen if a central bank buys government securities in the open market. What's going to happen to the interest rate? Is it going to increase? Is it going to decrease? Or is it going to not change? So remember, when a country buys government securities, that's going to increase banks' reserves and increase the loans that they make and thus increase the money supply. So we're going to have a shift to the right of the money supply curve, which is going to increase the quantity of money and decrease those short-term interest rates. So we should see an increase in the quantity of money and a decrease in interest rates.